It's time for another Mortgage Minute with Frank Napolitano from Mortgage Brokers Ottawa. He's going to answer some frequently asked questions about home financing and the housing market. Welcome, Frank.
Thank you, and good morning.
Good morning to you. The questions never end.
They never end.
When it comes to mortgages, housing, real estate, it's just never-ending question. But they're important questions. It's your mortgage.
Most people build their foundation around their home and their mortgage and being able to survive. So you know, have a roof for their families. So,
exactly.
Yeah, it's important.
All right, so let's get to the questions here. Let's get to question number one. Okay, now that the Bank of Canada has held its interest rate, can we expect fixed mortgage rates to start to come down? Our mortgage matures in February, and we really need lower rates to be able to afford our home. Frank, I'm sure you've heard this time and time again.
About $1 for every time I've heard that in the last little while. It's really hard for people. That was great news last week. Bank of Canada paused. We still have some headwinds against us. Oil prices have gone up to $90 a barrel. So inflation's likely to go from that 3.3 that we saw last month, probably up in the high threes. So again, that might put pressure on Bank of Canada to raise prime rate again, but most economists think that they're going to hold back. As far as fixed rates are concerned, the bond market's been hit and miss, and the bond market dictates what happens to fixed rates. So if your mortgage maturity is up in February, there's a good chance the rates could be slightly lower, but they're not going to be much lower. I think it's going to take a little while before we really start to see lower rates, unless some circumstance happens that you know, shuts down the economy. That'll obviously accelerate a little bit, but expect rates to come down a little bit, but not that much. So, you know, circumstance like that, if you can barely afford your home, you have to look at, you know, if you've got outside debt, you may have to re-amortize your mortgage. Maybe if you've got 20 years, you may have to go back up to 25 or 30 just to keep the payments in line for a little bit.
Okay. All right. Let's get to the next question. We need to pull some equity out of our home to consolidate some of our debts. You were just talking about debts here, and maybe set aside some funds for a rainy day. But we are adamant that we need to pay off our home in 12 years, as we're both hoping to retire by then. With interest rates so high, our bi-weekly payment is higher than we need it to be to live comfortably. How can we lower our payment for now, but still meet our goal of paying off in 12 years. Now, Frank, that's a tall order.
It really is a tall order, but it's not impossible. We have to accept the fact that we're in a period now where interest rates are artificially high. We're just going through this right now. It's expected that interest rates will be substantially lower 2 years from now. So you may have to increase your amortization to 15, 16, 17 years for now, and then lower, or once the rates come down, then you can keep the payment the same, and then that'll bring the amortization down. So it's either that, or worst case scenario, I say to some people, listen, if you're retiring and you've got an $850,000 home and you owe $75,000 on it, it isn't the end of the world. At that point, you can, if your income has come down because you've retired, so at that point, just increase the amortization back up to 25 years, keep your payments relatively low, and you get to still live in your house comfortably.
Yeah. Okay. So, final question. Let's go to that. Can we pull equity from our current home if we are interested in buying an investment property? Should we wait for rates to come down or do it now?
Well, again, depending on their circumstances, if they've got a small mortgage and they're pulling some equity out, the problem with buying investment properties today is because the interest rates are elevated and the property values are up. The rents, even though they're expensive, and everybody will tell you rents are expensive, they're not quite at the stage where it would cash flow the investment property. So we're not seeing a lot of activity for people buying investment properties today because your mortgage payment might be $4,000 and the rent payment is $2,500. So therefore you're down $1,500. That's not a very wise investment unless you end up with a property that has the potential for high acceleration in value real quickly. That's the only time it would really make sense. So we're not seeing a lot of it. So I would hold off though.
Okay.
Yeah,
and then Frank, and then a quick little question. I mean, when you do, those who are fortunate enough to invest in an investment property, they get that rent money coming in, that's fully taxable, right? That's it.
The rent is fully, so you have to include the rental as income, but then you've got the mortgage interest and the property taxes and the maintenance of the house.
You can write that
as
off.
an expense. So for most tax returns that I look at, people that have investment properties, they're pretty neutral, even though they may have made a little bit of money.
Okay. Frank Napolitano, always a pleasure talking to you. Frank Napolitano, Mortgage Brokers Ottawa. pleasure to have you on.
Thank you so much, and please continue to support local businesses and charities.